Keep calm, but don't wait and see. Rebudget and evaluate your finances now. Otherwise, you might be in for a rude shock in future. Hello and welcome to another episode of Moneywise. We help you to make sense of the world of personal finance and investing. In today's episode, we're going to take a closer look at how interest rates affect you. Some countries, like Singapore, are interest rate takers. This means our borrowing costs tend to track US interest rates. As Singapore is an interest rate taker, MAS does not directly set interest rates. So, to combat inflation, MAS manages our exchange rate against our major trading partners. Singapore banks use 3 interest rate benchmarks to calculate their interest rates. First, the Singapore Dollar Swap Offer Rate, or SOR. Second, the Singapore Interbank Offered Rate, or SIBOR. And third, the newest of them all, the Singapore Overnight Rate Average, or SORA. SOR and SIBOR are being phased out in favour of SORA. Since our interest rates track the federal funds rate, we can expect SORA to keep rising in step with the Federal Reserve's rate increments. So, how do these interest rates affect you? If you have outstanding household debt, such as a mortgage from a bank or a car loan, you can expect to pay more or less to service these debt obligations depending on how rates move. Even if you are on a fixed rate mortgage, you'll have to face the floating rate eventually once your fixed rate period is up. At present, some banks have stopped offering fixed rate packages and are only offering floating rate packages. For those of you on HDB loans, HDB's concessionary interest rate is pegged at 0.1% above the CPF ordinary account interest rate. So far, this rate has not changed in more than 20 years. However, given the state of the global economy and the rising interest rate environment, don't be surprised if CPF decides to adjust their rates. Landlords and business owners with sizable outstanding debt could face higher debt repayments due to rising rates. They will inevitably pass on these higher costs to you, the consumer, by raising prices. For example, landlords may raise the rent for their tenants. For commercial properties, this could mean the business renting the unit may raise prices for their customers. In the end, it is the consumer who has to pay more. Assets like real estate and stocks are likely to face market corrections eventually. For real estate, buyers are likely to be put off by the sudden surge in borrowing costs, since they would have to pay a lot more to service their debt repayments. Because demand falls from cautious buyers staying out and supply remains high from eager sellers rushing to cash out before rates rise further, prices drop. For stocks, we have a variety of factors. First, as companies and consumers grapple with higher debt repayments, corporate earnings may stagnate or drop. This happens because companies face rising costs and consumers are spending less. Secondly, in the stock market itself, investors may sell their investments as they need the cash. With more selling pressure than buying pressure, stock prices fall. The effects of interest rates we have just talked about are just some of the drawbacks of fiat currencies. Fiat currency, or legal tender, is the money we use, and they have value assigned to them through government decree. However, the main drawback of fiat currency is that control is centralized through central banks, and they have the power to print any amount of it, affecting inflation and interest rates. This is why supporters of cryptocurrencies are advocating for a radical overhaul of the money system in favor of crypto. We shall explore this future possibility in another episode. In conclusion, prices and interest rates will likely continue rising for the time being. Keep calm, but don't wait and see. Rebudget and evaluate your finances now to see if you're impacted and if you need to make changes. Otherwise, you might be in for a rude shock in future. Thank you and see you again for another awesome episode of Moneywise.